Good afternoon, everybody. It is Jeannie Fisher with Argy, and boy, do we have some news today. What is this yield curve that everybody is talking about, and why does it matter that it's inverted? Well, let's break it down. The yield curve is actually a scatter plot that shows the yield or interest on treasury bonds over different time periods. Okay, so let's look into that. A treasury bond is important, and we follow it because it is generally considered one of the safest forms of investment out there. A treasury is where the US government is borrowing money, and the yield that we discuss is the interest rate that they are paying to borrow that money. Now, political jokes and opinions aside, that's why it's generally considered the safest, because it's the US federal government that we're talking about. Now, what you would generally expect in a normal market environment is a yield curve that looks something like this. And what that means is that the longer you are lending that money to the government, the more interest or yield they are going to pay for that. Now, that makes sense because if I'm going to loan you money for 30 years, I expect you to pay me a little bit more than if I just loaned it to you for 10. When we have an inverted yield curve, it looks something like this. And what that means is that the yield on the shorter term treasuries is actually higher than on the longer term. So now why does this matter? Well, it is seen as a regular indicator of a recession. And what I mean by that is, of the last 7 recessions that we have had, they have all been preceded by an inverted yield curve. What we're seeing is longer term yields are actually falling as investors express concern over trade wars. We have lackluster inflation. There's a lot of indicators out there that are making people a little bit nervous about the long run. So the question becomes, what should I do? Well, on the other side, after the last 7 inverted yield curves we've had, the S&P 500 has rallied on average 13.9%. So yes, historically speaking, recessions have been preceded by an inverted yield curve. However, not all inverted yield curves have led to recession, and more importantly, there is a lag. There is a real lag between the inverted yield curve and a sustained correction in the market or even the recession. So data shows that in the previous examples, it has been an average of 18 months from the point the yield curve inverted before the stock market showed sustained negative returns. So again, it doesn't always mean that a recession or a correction in the market will happen. It is or has historically been a good indicator, but to add to even more to the uncertainty is that lag. That lag can be long. So as an individual investor, this isn't the type of news, even though there's a lot of noise and a lot of information being pushed out, this really isn't one of those things that you can go act on. For most of us, we are long-term investors. We're not trying to profit anything, in day trading. So for most of us, we want to stay the course. If we have a financial plan from a certified financial planner, we have an investment strategy in place. Our investment strategy matches our risk tolerance and the specific goals of that account. This is not the type of thing we want to try to time. It can be very difficult to successfully and repeatedly time the market with this type of news. So if you're comfortable in your plan and you're comfortable in the investment strategy you have put forth, stay the course. But hopefully this did explain some of that noise, and maybe now you know a little bit more about yield and an inverted yield curve. I hope that you guys have a great day, and we'll talk to you soon.